Good afternoon, financial professionals. Abby Fletcher here of E4 Insurance Services, welcoming you to the BREW, Building Relationships Every Week. Thanks for tuning in today. For those of you joining the BREW for the first time, welcome. We're glad you're here. Today's BREWcast is being recorded and will be posted on YouTube this afternoon. Check out our BREW blog at E4.Insurance for our entire library of content crafted for today's financial professional. Today on the BREW, as part of our advanced planning series, we have E4's very own Shane Van Patten, who serves as Regional Vice President as well as Resident Long-Term Care Guru. Today, Shane will be sharing ways to make the long-term care planning conversations both comfortable and easy for the financial professional and the client. He'll also share E4's proprietary long-term care analysis and how this program adds ease and comfort in the planning conversation. Shane brings over 15 years of experience in the financial industry and recently served as Board of Advisors for the Certified Long-Term Care designation. You'll recognize Shane's passion around long-term care planning, as he himself is a son of parents who both needed long-term care in their 60s. This experience, coupled with his passion in helping financial professionals, positions him as a leader in long-term care planning. Many of us on the BREWcast, myself included, have known Shane for all 15 of those years. So we're all longtime fans of the Shane Van Patten Show. Feel free to use the chat box down below while Shane is live. I'll be keeping an eye out for your questions and so we can provide real-time answers. Also, all attendees are in a drawing for a free continuing education course, and we'll be announcing the winner shortly. Thank you for tuning in, and without further ado, Shane, welcome. The mic is yours.
Thank you, Abby, and thank you for the great introduction. Anybody that knows me personally, or anybody who's worked with me before, knows that I can talk about insurance for hours. So I've been tasked to give an overview of the long-term care planning conversation in about 12 minutes. So with that, I'm going to jump right into it. Really, the goal today is to give you a high-level overview of the long-term care planning conversation that I personally use. I usually break this up into 2 meetings. Some people might put it into 1 meeting. Some people might put it into 3 or 4 meetings. But really, the high-level overview of my 2 meetings. The first meeting is really a fact-finding meeting. So I'm asking a lot of questions to the clients. What do you know about long-term care? Have you had any personal experience? Have you done any long-term care planning before? I'm really trying to get the client set up for creating a long-term care plan of care. And once we get there, then we're really giving an educational overview on the different funding vehicles or options that are available to pay for their plan. So as you see that I have on the screen here, I have no products. In that first meeting, I personally don't like to bring product, as I don't want to be perceived as I'm selling something. It is truly just creating that plan. And we're going to go into that a little bit more. And when we get done with meeting number 1, it really sets up for meeting number 2. And meeting number 2 is, now that they have a high-level overview of the funding options, we've eliminated which ones just won't work. We can really go into a deeper dive and really analyze the different options to figure out which one's best. And I think that's where E4 Insurance Services proprietary long-term care analysis fits in just perfect. I prefer to always lead with an executive summary, what the long-term care analysis is. As we kind of send out in the invite, I think illustrations are great. They are required, but I also believe illustrations were created by attorneys, which makes them very lengthy. They can be confusing, and oftentimes it'll paralyze the client in the planning conversation. So let's go a little bit deeper in just the meeting number 1, creating a plan of care. What I really need from the clients and their family are answers to 4 questions. So the first question is, where do you want to receive care? We want to receive care in a nursing home, assisted living, home health care. Next question is, who's going to physically provide the care? Do they want their spouse to provide their care? Do they have a daughter or son that'll provide the care? Or would they rather have a professional caregiver providing the care? Question 3 is who's going to coordinate the care? And the last question is who or what is going to pay for the care? Once we've created the plan, we have context around what their wishes are. From there, we can go to the next step, which is, actually, I'll back up here. When I go through this with clients, many of them don't have those answers for me in that first meeting. So I usually will bring up my own suggestion as to what I believe a recommended or a good plan of care would look like. So Mr. and Mrs. Client, if I can create a plan for you that allows you to remain safe in the comfort of your own home, would you agree with that? With this plan, I also want to make sure that I protect your spouse and your children physically by allowing them to supervise or manage your care, not roll up their sleeves and provide the care. And finally, I want a plan that makes sure that it protects all of the previous financial commitments that were set up for the family. So if a long-term care event does happen and a monthly cash flow issue is created, the family can still maintain their lifestyle. So just to summarize, receive care in the comfort of your own home, protect the family, both physically and financially. That's usually the plan for most clients that we create. And once we have that plan, the next educational overview that I go through with them is, who or what's going to pay for the plan of care. So the first one we talk about is Medicare. And I have to tell the clients that Medicare is health insurance. Even if you get through all the red tape, which there's a lot, the maximum it'll cover is 100 days, which is really short-term care. It's not long-term care. And oh, by the way, care is received in a skilled nursing facility, not in your home. So it doesn't fit the plan that we just created for you. The next option is Medicaid. Medicaid is a welfare program, which means it's a viable solution for clients that don't have any money. Another way to look at it is it's an extremely expensive option for clients who do have money when you take into consideration the spend down requirements for each state. And oh, by the way, care is received in a skilled nursing facility, not in your home. It does not fit the plan that we just created for you. Next option is self-funding. When I talk to clients or financial professionals, I really don't care how much assets or income the clients have. That's really not my litmus test to determine if they can self-fund or not. For me, the litmus test is if they can, again, long-term care creates a monthly cash flow issue. If they can come up with an additional $4,000 to $8,000 or more per month to pay for this brand new expense without affecting the family's lifestyle, then I believe that they could self-fund or self-pay for long-term care. The last one is long-term care insurance. So what we're talking about with insurance is transferring some of our money in some way, shape, or form to transfer some of the risk to an insurance company. At the end of this overview, the client has now realized they really have two choices. They can keep all of their money, hold all the risk personally, and they have to internally accept 100% of the consequences to their family. Or they can transfer some of their money, again, in some way, shape, or form, and transfer some of the risk to an insurance company and mitigate some or all the consequences to the family, emotionally, physically, financially. So at the end of that meeting, what we've done is we have a plan of care. Anytime that things get confusing, I always go back and talk about the plan. Again, we want to keep you safe in the comfort of your own home. We want to protect your spouse and children physically. We want to protect your family financially. You only have two choices: keep your money or transfer some of the risk to an insurance company. Meeting 2 is really the deep dive into really just running the math, right? It's a mathematical formula as to what would make the most sense to help fund this plan. So whether we use personal assets or we use insurance, we really have to have a planning goal. And that planning goal is to create a predictable cash flow at a certain age. I typically use age 80, but we want to create a predictable cash flow at age 80, for example, to pay for a potential brand new expense in retirement, which is the long-term care event. This is where E4 Insurance Services proprietary long-term care analysis report or tool works really well because it's just an executive summary that compares the two choices the client has, and that's self-funding versus the various types of long-term care insurance products that exist. So the best way to go over this is we're just going to dive into the long-term care analysis. So I'm just going to do a quick case study. You know, if everybody can think of a client or somebody they personally know, maybe it's even you yourself, but it's a male, age 61, they're married, and they're a non-smoker. We've created the plan of care for this individual, and they've determined that they would like a pool of around $500,000 available to pay for a potential long-term care event happening at age 80 that would last 4 years. So with inflation on the cost, things like that, we're really shooting for a monthly, a predictable cash flow of $10,000 a month at age 80 to pay for a 4-year long-term care event. So what I'm going to do here now is introduce you to E4's proprietary long-term care analysis form. So we'll just start. I'm going to go through page by page, give you a high-level overview, and if we have questions, we can just hold those to the end. Page 1 is just a static cover page for the analysis. The only thing that'll ever change on here is the prepared for, specific for your client, and prepared by you. Page 2 is also a static page in the report. This is really, again, the educational overview for a client, kind of a leave behind of the introduction to long-term care. What is long-term care? What are the activities of daily living? What are some of the common reasons that people might need long-term care? If they have an event, what age is the most common? Age 80. And then it really identifies, you know, where do people receive care? Is it in home health care? Is it in assisted living? Is it a nursing home? So it's just a static, nice overview sheet for the client. Page 3 is where we really get in specific. So this is going to be specific for your client as well as the state they live in. So this individual, 61-year-old male, up in the top left, and we're anticipating in 19 years at his age 80 that he's going to have a potential long-term care event lasting 4 years. So if you look down to the bottom of the sheet, it's got the North Dakota state median long-term care costs. We see the current monthly cost for home health care, about $5,500 a year. Assisted living, just under $4,100. Nursing home, $12,764. What we know is we're projecting this LTC event to happen 19 years from now, so years until event 19. And we're anticipating that each of these different service and the cost that's associated with it's going to probably increase about 3% over each year for the next 19 years. So what we've done is showed a future monthly cost, and it kind of compares to the client's idea of having $10,000 a month for 4 years. And I think we're right in line for this client to fully offset the cost for home health care, assisted living, and it's really a 50% copay in the event that it's a nursing home event. But again, if you go back to our plan, the goal is really to create a plan that keeps them safe in the comfort of their own home. And with the $10,000 here, we're right on pace for that. So page 4, this is really the highlight of the, call it the meat and potatoes, I guess. I mean, this is the highlight sheet. So at first glance, it might look like there's a lot. So really where I want everybody to pay attention is, obviously we have vertical rows and we have horizontal rows. So the first thing I'm going to look at is the vertical rows, and specifically the each of the heading topics. So the two blue colored boxes, those are going to be the self-funding. This is in the event that we're creating our own sinking fund. Outside, we're not considering insurance, we're creating our own sinking fund that's going to help be the vehicle that acts and pays for the plan at age 80. The two orange boxes are going to be hybrid long-term care. So if anybody's done MoneyGuard, Nationwide's Care Matters, Security and Secure Care, One America's Asset Care, that's going to be the type of product there. The green box is going to be the life insurance, permanent life insurance with either a long-term care or a chronic illness rider. And on the far right is going to be the traditional long-term care. Your traditional pay-as-you-go, use it or lose it, is the vehicle that we're going to have there. Now, one thing you want to take notice is anything in the blue colored represent all guaranteed values. And again, just for So guaranteed based on claims paying ability of the insurance company, but these are all guaranteed values. Now, if we look at the left-hand side, we're really looking, what do we want to know? What we know right now is the client has a plan. We know that we have a goal of creating $10,000 a month for 48 months at age 80. So we have 19 years to get there. So when we look at the boxes on the left-hand side, what we need to know is how much is it going to cost us? For how many years do we have to pay it? What kind of rate of return do we need to earn each year for the next 19 years? And then the third box, if care is needed. We know what the day one benefit, but I'm really highlighting the age 80. How do we get to that $10,000 a month? Now, what happens a lot is after we get many clients that want to know, well, what if I never use this and I just live another 5 years and pass away in my sleep at age 85? What's left to the heirs? So we also include that box. The next one's after that, flexibility, funds available if needs change, yes, no. And the types of claim, how's it paid out? Is it cash? Is it cash indemnity? Is it reimbursement? So I'm going to walk through just kind of how I would present this. We know the goal, again, is $10,000 a month for 48 months or 4 years at age 80. If we look at the top left blue box under the self-fund, a client today would have to carve out $286,000 and create their own sinking fund vehicle that would be available for this. Now, the rate of return that they would have to earn is a 3% net. So that's after taxes, that's after advisor fees. And earning that 3% net each year and every year for the next 19 years, the client would have the $10,000 they need per month for 4 years. I'll just bring it up right away. So if any wealth advisors are on the call, I do get a lot of people that say, well, 3% net, I think we could do more like 7 or 8% by investing. And you know what, I agree with that. I do believe if we did 7 or 8%, and that's the calculation we used, we would also have to show the client that the portfolio or that asset's down 7 or 8%. And based on my experience, clients, when they've created the long-term care plan and we're choosing a funding vehicle, they're really looking for predictability. Right? Take away the taxes, market timing, all that stuff, but they're just looking for predictability. And when we go out and we just invest it, we don't have that predictability. The other thing that usually happens, again, this is based on my experience, is if a family has a long-term care event, they're not going out to their investable assets that are earning 7 or 8% and liquidating those to pay for care. They're actually going to their lowest yielding assets in their portfolio, and they're pulling it from there, which happens to be often cash. So think savings accounts, CDs, money markets. So if that's where they're actually pulling the cash and we're using a 3% net, I actually feel really comfortable. In fact, we might be showing too high of a rate of return, but we're comfortable with a 3% net. We can always have more questions after that. So if we know it's going to cost $286,000, the first thing I'm going to go to is the first orange column, or yellow, or whatever color, looks like orange to me. We could actually accomplish the exact same thing for about $170,000 less. Instead of paying $286,000, why don't we just put in $117,000, have that guaranteed initial value of $5,703, but guaranteed to grow at 3% compounding, again, guaranteed based on the claims paying ability of the insurance company. And it just creates the absolute predictability. We don't have to worry if our sinking fund earned 3% for that year or not. It's just absolute predictability. And if we never need care, so we fast forward from age 80 to age 85 and we never use care, yeah, the death benefit's $136,000. That's less than a 1% income tax-free rate of return on our money. Was that a good deal or a bad deal? Depends. If you never needed care, it's probably not a great deal. Clients often will look at that and they'll compare it to the 581 and say, there's a lot more money here for our heirs if we never used it. So I have to go back and remind them that yes, but we're also, creating predictability, and we're doing it for $170,000 less. If it's important to you to leave something to your heirs, we can certainly take that $170,000, we can invest it. And in fact, if we invest it, we can be as aggressive as we want, or maybe we'll even consider doing some single premium life insurance with strong guarantees, or maybe a combination of both. So now all of a sudden the clients start understanding what we're talking about. The second blue option is the self-fund. So maybe a client doesn't have $286,000 to reposition, but they want to create the same sinking fund earning 3% net, and they're going to put $32,000 a year into that each year for the next 10 years. If they earn 3% net every year thereafter, at age 80, they'll have the $10,000 a month for 48 months that they need. Now, when we compare that to the second orange hybrid LTC, again, we can get to that same predictable goal for much less. So we can do it for $14,377. Again, at age 80, if we need the care, it's predictable, it's guaranteed, it's there. And we've done it for much less than what it would have done in the sinking fund. Fast forward to age 85 and they never need care. It's a return of premium on our money. Is that a good deal or a bad deal? Yeah, you had the protection, but mathematically, it's a bad deal if you've never need care. Now, again, if it's important to leave something to your family, a charity, we could take the difference of the $32,000 and the $14,000, which if my math's quick, $18,000, and fund that into something for the next 10 years. Investments, insurance, combination of both. Green option, life insurance with the LTC rider. The benefit there is we are buying $500,000 death benefit. It's also a $500,000 pool of long-term care benefit. So we have $10,000 available day one. We can still do it for about $11,000 a year, less than creating our own sinking fund. And if we never use it, pass away at age 85, we have a 4.23% income tax-free rate of return on our money. That's a pretty good deal. When you look 19 years out at life expectancy, and we have a 4.23% income tax-free rate of return. And if they still want to do something even more, and we're still $11,000 a year less, we can put that into investments, other insurance, or a combination of both. The last one here, traditional long-term care, is the lowest cost. We do have some 10-pay options on this illustration I just showed, paying in all years. It is by far the cheapest at $2,644. We pay this every year. Yes, the premiums aren't guaranteed. I do believe insurance companies are extremely stable in their pricing. That's a whole separate conversation. You can call me anytime. When I look at this, again, most clients don't like that the premiums aren't guaranteed or the use it or lose it. But what I tell clients, I tell advisors, I tell insurance agents, if your clients can't cash flow any of the first 5 that we've talked about, what choice do they have? This is by far the best solution available for them. And if they happen to have, if you go back to the amount needed for the self-funding, $286,000 in an investable asset, earning that 7 to 8%, right? We don't necessarily want to liquidate that to do any of these other options. One solution is, well, great. If we have $286,000 earning 7 to 8%, let's make it a plan to peel off 1% of interest earned every year, which is about $2,860. Take a distribution every year from that. We'll peel off 1% and have that pay for the long-term care. When clients see the $2,640, any insurance premium for that matter, when you put a dollar amount in front of the client, most of them are thinking about their own personal checkbook. What do I have to give up in my current lifestyle to be able to cash flow this insurance that I know I need? But I really don't want to give up my current lifestyle and my checkbook to pay for this. If you can show them a way to peel off interest from the investment portfolio to pay for it, there's a much higher success that they'll say yes. So the last thing I'm going to go over, again, high level overview. When I use this, I am not looking for the client to just point to one and say, that's the one I want to do. I wish it worked that way, but it usually doesn't. Clients, can still be paralyzing to them. There's a lot of options, and they're very scared to make the wrong decision. So what I like to use is the process of elimination. Mr. and Mrs. Client, which of these options do you absolutely really not like? And usually it's going to be, not always, but a lot of times it's going to be, well, I don't like that $286,000 in the self-funding, and I don't like $117,000 repositioned either. Great. We've just eliminated 2 out of the 7 strategies. We've given the client an easy first win. They were able to make an easy decision, and we're still moving in the right direction. And now we know that we're dealing with cash flow. We're going to deal with income. Now we get into a conversation of, can we cash flow it for 10 years? We want to have it paid up before retirement. Can we cash flow longer? But we continue to use process of elimination to get us down to a lane the client likes. And from there, we can start going deeper into illustrations and, other things like that. So I'm going to close this out. That's really the high overview. I'm looking at the time. I did not do it in 12 minutes. Again, it's very hard for me. I'm very passionate. I love insurance. I talk about it all the time. But if you have any clients in mind that you really want to see one of these, the power of the long-term care analysis, reach out to your RVP here at E4 Insurance Services. If you don't have an RVP, there's an email address up on the screen that you can email. Best practices, we do ask that you give us at least a 48-hour kind of heads up notice before you would need this. It's not that they take a long time. It's one of those things that you really need to be focused on. And when you get distractions, it can be hard. So if you can give us 48 hours notice, it's very helpful for us. And the more information we know about the client, what kind of assets do they have? Is it qualified assets? Is it non-qualified assets? What kind of source of funds would be available for these clients to pay? If it's income, is it forever income, or is it until they retire income? It really helps us design whether we're showing a 10 pay or a full pay or anything in between. And then also any known health issues. The long-term care analysis does a great job. But at the end of the day, clients have to medically qualify for this. There's some products that are more liberal in underwriting than others. The more information we know, the better recommendation that we can provide you. And just with the health in general, usually at either the end of meeting 1 or the end of meeting 2, somewhere along that, it's very important to do the field underwriting, pre-screen the clients, what kind of doctors have you seen for the last 5 to 10 years? What kind of medication are you on? What's the name, dosage, reason, those types of things. If you are looking for more information on that, you can also give us a call on that. So in summary, don't lead with an illustration. Don't even lead with a product. Just create that plan of care first. Everything gets tied back into the plan. Don't lead with illustrations. They're confusing, right? They're lengthy. They often paralyze clients. With any type of insurance, but especially long-term care, just lead with an executive summary. Use the process of elimination to get easy wins and move into the right area, and you'll have a much better planning experience with the client. So that's my high-level overview.
Thanks, Shane. Thank you. I've just opened the line for any questions from the audience. And while those are queuing up, Shane, I have to say, I didn't hear you say once that long-term care is not the plan. That's a Shane Van Pattism.
Well, yeah. So it goes back to why create a plan first, right? The product is not the plan. The product is one of many vehicles or options that can be used to fund the plan. So when we lead with a product, I truly believe that financial professionals are creating their own they're creating their own selling environment when they don't need to. I mean, it's just so much easier to create that plan, not have any pressure that it's an insurance conversation. It's a planning conversation. So good catch, Abby. Thank you.
Well said. Well said. Wanted to make sure we gave them their money's worth. Okay. Sure. Now coming in from the audience. Can you talk about how retirees think about long-term care versus the reality of it? Do you have to change the perspective?
Yeah, I think you have to change the perspective. I think the biggest issue when it comes to long-term care planning, and this is both for financial professionals and clients, is when and where they believe long-term care begins. So most clients that I talk to, they have this envision that a long-term care event is them in a nursing home, flat on their back, in a hospital bed, unable to do anything. And I have to remind them, how many people do you know that were active, engaged, and healthy in retirement, and literally the next day just couldn't do anything and were in a nursing home? right? It starts much, much sooner than that. It starts with somebody needing help getting out of bed in the morning, somebody there to safely make sure they can take a shower or bath without getting hurt. And then they start their day, right? So that's really where it starts. And that's the part where we want to protect that spouse physically, right? My wife can't move me today. It's for me to expect in 50 years, she's gonna be able to move me is, just crazy. But that's where it really starts. And that's where we're planning for, right? Once they actually, if they're in a nursing home and they're unable to do anything, it's at that point where their lifestyle expenses for them individually are pretty much gone. And we can start, redirecting some of that income, things like that, because we do have freed up lifestyle expenses that we can use towards paying for it. But I don't know if that answers the question. Not again, you get me started and I'll talk for hours on this stuff.
It sure did answer. Any other questions from the audience? You dazzled them speechless, Shane.
That's great.
Let's go to the drawing. Give me a number, sir, from 1 to 34.
I'm going to go with 11.
Good one. Who's the winner? Who's the winner? Mike Patterson, congratulations, sir. Be on the lookout for an email coming your way with a complimentary continuing education course from all of us here at E4. And thanks for tuning in today. Be sure to join us next week. We'll have Bridget Oakes of Great American Insurance Group speaking on the Secure Act and how this has changed the way clients can inherit tax qualified assets. Thanks for tuning in and have a great day.